Hello, and welcome to another episode of the Markets at a Glance series. My name is Rufas Kamau, Markets Analyst at FX Pesa. So thank you for joining the session. Hello, Caspar. Hello, Francis. I appreciate having you in this space. So let's get things going. So first things first, I would like to begin by saying the king is back. And by saying the king is back, you know what that means. The dollar basically started pretty strong for the day. So what you're looking at here is the chart of the dollar index. It has been on a bearish momentum for the last 3 days, including today, making it fourth. But then, from what we are seeing in this channel, we saw a pretty bullish Asian session. So during Sydney and Tokyo sessions, the market was basically moving up. And then as we approach the London session, what we saw is the market reversing direction and moving all the way down and getting to this lower trend line. So from then, we have seen the dollar index basically bounce from this lower trend line. And we know that from our technical analysis, there's a high likelihood that the dollar index is headed towards the upper trend line. So in this case, seeing the dollar index making this strong reversal, looking at the opening price of the day and the current price, it's clear that the dollar index is making some gains and we end up winning towards the end of the day. So having seen this, we understand that going forward, we should be expecting the dollar to be strengthening against other currencies. And this can be a key basis of our analysis today. So besides this, there's more stuff happening in the markets. And I think the most potent news of the day that has caused the most volatility is basically the actions of the Bank of Japan early this morning. So the Bank of Japan was having a meeting this morning to decide on interest rates. So the Bank of Japan kept its, try and highlight this, kept its key short-term interest rate unchanged at negative 0.1%, as has been the case over the last couple of years, and that of the 10-year bond yields at around 0% in its October meeting, as widely expected. At the same time, the central bank redefined 1.0% as a loose upper bound rather than a rigid cap and scrubbed approach to guard the level. Since July, the long-term interest rate has been capped at 1%, an increase over the previous cap of 0.5%. In a quarterly outlook report, the Bank of Japan revised higher inflation forecasts for full year 2023 and 2024 to 2.8% from 1.3% and 1.2% respectively. So what this basically means is that the Bank of Japan is acknowledging that it's losing in the battle to control inflation and keep it at the target rate of 2%. And now it's projecting that inflation may remain elevated, basically averaging 2.8% over the next 1 year. So this is exceeding the 2% target, meaning that the Bank of Japan is acknowledging the effects of high inflation on the Japanese economy. So as a result, it basically decided to adjust its upper band on the yield curve control program from a hard cap of 1% to a flexible cap of still the same level. So what this means is that the yields on Japanese government bonds can be allowed to trade higher than 1%. So in the previous policy, whenever the yields would approach 1%, the Bank of Japan will be forced to print out of money and then buy the excess demand from the open market. Then these would basically mean yields remain suppressed below 1%. So the trend we have been seeing is basically a shift from 0.25% early in the year. This was then doubled to 0.5% and then doubled again from 0.5% to 1%. So with the yields rising and getting closer to 1%, then the Bank of Japan is changing policy and allowing these yields to move even higher. So in other economies, yields are basically open. They're not capped. For instance, in the US, the yield on the 10-year bond has recently hit 5%. So when you see yields moving freely, then it basically means that if they are breaking higher on the upside, then there is a higher demand for those bonds. So in this case, the Bank of Japan is gradually, bit by bit, removing the limits on these bond yields to allow them to move higher in preparation of what we may describe as quantitative tightening as we move into 2024. So in this case, when you think about tightening, it's basically the government trying to remove the excess liquidity from the market. And the way it does this is basically by reducing the amount of money in the markets. And this may involve one, reducing the rate at which it's pumping money into the market, and then two, increasing interest rates. So the Bank of Japan cannot hike interest rates at the current conditions. So it may have to first of all stop printing money and then move on to hike interest rates. So this is something that investors have been following, and there were wild projections that the yield curve control would be expanded to 1.5% today. So that did not happen, but all the more they adjusted the 1% target, and now it basically means that the yields are allowed to move slightly above 1%. So for full year 2025, the CPI is projected to ease to 1.7% due to the waning impact of high oil prices and the past rise in import prices. Meantime, policymakers viewed that Japan's economy was likely to continue recovering moderately, supported by pent-up demand, but highlighted downward pressure from a slowing global recovery. So the board reiterated that it will not hesitate to take extra easing measures if needed. So when you see these policy stance being changed, and this is slightly under a year after the new Bank of Japan governor was appointed, then it basically raises hope for investors that have been hoping that the current policy would be changed, and at some point the Bank of Japan would begin tightening. So there's more content from Financial Times. So just a moment, I need to fix my internet. Sorry, my power. Thank you. So the Bank of Japan has taken a significant step to end its 7-year policy of capping long-term interest rates after a sharp rise in US bond yields, setting the stage for a gradual unwinding of massive monetary policy easing measures as it sharply raised its inflation outlook. So the Bank of Japan's policy board on Tuesday announced a near unanimous decision to allow yields to the 10-year Japanese government bond to rise above 1%, revising its so-called yield curve control policy for the second time in 3 months. So the bank said that the 1% ceiling on 10-year bonds would be regarded as a reference, noting that strictly capping long-term interest rates could entail large side effects. The Bank of Japan previously said it would offer to buy 10-year bonds at 1% in fixed rate operations after raising the cap from 0.5% in July. So the Bank of Japan Governor Kazuo Ueda said the board wanted to make the controls on the bond market more flexible as a step to avoid future volatility in financial markets, including currencies. So in July, we did not think that the 10-year JGB yields would approach 1% so quickly, Kazuo Ueda said at a news conference on Tuesday. So the biggest factor behind this is a bigger than expected rise in US Treasury yields. So the decision marked one of the Bank of Japan's biggest steps towards exiting its long-running experiment with ultra-loose monetary policy, as the weakening yen, rising bond yields, and persistent inflation put pressure on Ueda to begin unwinding core parts of its accommodative stance. So the central bank maintained its policy rate at minus 0.1%, the world's only negative interest rate, but it also significantly revised its inflation forecast upward, saying it expected 2.8% core inflation in the 2024 fiscal year instead of its previous forecast of 1.9%. In its final phase, the yield curve control seems to have become more of a dead letter, said Hiroshi Miyazaki, a senior economist at Mizuho Research and Technologies. Investors will question the BOJ stance that it will patiently continue with monetary easing, so they will expect the next steps, such as the lifting of negative interest rates, to happen more quickly. So price growth in Japan has been more persistent than expected this year, with annual inflation at 4.2% in September, excluding energy and fresh food prices. So Ueda has argued that the main factor pushing up prices is the rise in import costs. So what we have seen is the Bank of Japan basically implementing policies that are weakening the yen. So as a result, if we refer to the chart, if you look at USD JPY, then you notice what has been happening. So right from the beginning of the year, and this was January, we are seeing an exchange rate that literally started around this area here. And this exchange rate has worsened by about 15.41%. So what this means is that Japanese imports have, at least as a result of the exchange rate, increased by 15%. So any people or corporations in Japan that import products from other countries, they have seen the prices of those products increase by at least 15% this year. So this has become a problem because they basically transfer that problem to the final consumers. And when they do that, it becomes quite a burden for the economy. So the growing gap between borrowing costs in Japan and those of US and Europe, especially after 10-year US Treasury yields surged to their highest levels in 16 years this month, it has forced the Bank of Japan to repeatedly make large Japanese government bond purchases to keep yields below its 1% ceiling. And this is basically overstretching the Bank of Japan. So ahead of Tuesday's decision, the yen touched new lows against the dollar as hedge funds tested Japanese authorities' willingness to intervene to defend the currency. So it's another problem that the Bank of Japan has been facing. So with such a huge difference between Japanese bond yields and US bond yields, a lot of investors have been speculating and trading these policy divergence, and this has been implemented by buying the USD JPY and continuously testing the ability of the Bank of Japan to intervene in the currency market. So as a result, what we have seen is basically yen that was strengthening yesterday, and then today it erases all the gains that had been made yesterday, Friday, and of course Thursday. So we have cruised through all those levels within one day and broken above the proverbial 150.769 price level, which has been the intervention mark. So the last time price was here, we saw some intervention happening here. We also saw some intervention happening here. And this intervention was slightly below that level. So this is when the USDN was trading at 150.142. And of course, if you go to a higher time frame, you'll notice that the last intervention also happened at a similar location or price level. And this was slightly above 150.142, with the highest price that was reached then being around 151.897. So in this case, there's a lot of speculation that the Bank of Japan may choose to intervene in the currency markets again. And from what we are seeing with the adjustments in the yield curve control, the Bank of Japan is no longer willing to print massively in order to basically control yields. So it's basically allowing yields to move higher. And in this case, it won't have to print more, which is supposed to be good news for the Japanese yen. So despite the strong momentum that we have seen today, the overall expectation is that the Japanese yen starts strengthening again. And in that case, we could be seeing a reversal of this move. And that's what a lot of investors are waiting for, because it would be a long-term entry position that could be held for a couple of weeks or even for a couple of months. So if you have any questions regarding the presentation, feel free to type them, and I will be ready to respond them as soon as I see them on the comment section. So the ultimate objective is to engineer an exit from the yield curve control without explicitly telling the market they are doing so. It will be filling in the dark to test how far above reference range can we get. But the direction of travel is clear, said Benjamin Chatil, a foreign exchange strategist at JP Morgan. So the yield on 10-year Japanese government bonds hit 0.941% after having risen to as much as 0.957% in morning trading ahead of the announcement in its highest level since June 2013. So we're looking at a decade high yield for the 10-year JGBs. So the yen fell as much as 0.9% against the dollar to a low of 150.41. The Japanese currency is down about 12.8% against the dollar this year. So knowing what we know, what we are looking at is a market that has basically been showing very strong bullish momentum. So right now that we have seen the market has broken the upper trend line or the upper resistance and crossed significantly higher with a very strong green candlestick, then it raises the question of whether we will actually get to the previous high that we saw here. So if you go to the daily chart, zoom out, this is the highest price that we saw last year. So are we going to get to the price that we saw as a high last year? So that's the big question that every investor or USD JPY trader is asking themselves. And then looking at the 4-hour chart, you can see that it's clearly possible. It would only take, let's say, 1 or 2 candlesticks to get to this price level. So the new target now becomes 151.897 after the market has broken the 150.769. So this represents a potential gain of, let's say, this is around 963 points or 96 pips, which would be a 0.64% increase in the USD JPY currency pair. So there's that likelihood, but then anyone who is trading this particular pair and let's say you're bullish on this, you have to be very careful because the interventions are not announced. So if you decide to go along on this one, make sure that your stop loss stays pretty tight, just in case there's any form of intervention, then you wouldn't have to be kicked out of the markets. So that's something that you should strongly consider, especially if you are a USD JPY currency trader. Hello, Haki, I can see Ambrose, Tapscade, Mana. Thank you for joining the session. A very nice question. What is the meaning of employment cost index? What is its relevance to trading? So employment cost index, it's basically the cost of employment or the amount of money paid to employees that are not serving in the military. So this basically means all other government employees as well as employees in the private sector. So you want to see how much money is going into the economy. So this index will help you understand whether there is more and more money going into the economy or less and less money going into the economy, which can be a leading indicator of spending trends. So if that is weakening, then you know spending trends will also be weakening, which have an impact on stocks as well as an impact on the currency itself. I think I got this question earlier in the day again. What is the symbol for the dollar index? So just type USD index Z3 and you'll get that on your MT5. So if you're searching it online, it's usually DXY, but from the FXPesa platform is USD index. So US 500 is the S&P 500 index. It's not the dollar index. How will we know the Bank of Japan has intervened on the yen? They don't announce. So it's the one risky move that can happen in a time. So the only thing that you'll see is a big spike downwards, meaning that the yen is strengthening against the dollar within a very short period of time, but then there will be no announcements. So if the Bank of Japan decides to intervene in the currency market, obviously they will not be announcing this because they don't want traders to be front running them. What do you think of gold amid the Middle East unrest? Gold has been enjoying some good momentum. This month, it's up over 7.6% since the beginning of this month. And this is basically indicative of investors rotating to risk-off mode, basically considering the current situation in the Middle East and how it could accelerate. Investors are taking some hedging options to make sure that their portfolios are safe. And one of the ways they've been doing it is by buying safe haven assets. Some of these safe haven assets include the US dollar, which is having some really good deals on its treasuries. So USTs have been the number one hedge asset. but then also some allocations in gold, some allocations in Bitcoin, among other currencies. So in this case, as long as the conflict continues getting worse and worse, then we should be expecting to see a much stronger price of gold. So having answered these questions, let's keep going. So the overall expectation is that the USD JPY gets all the way up to 151.897, and that would present a nice trading opportunity. But then if there's intervention, then there should be a very sharp sell-off in this pair. So if you're looking to squeeze in a position, perhaps you should be looking to be going for a bullish trade. But then if you're a patient trader who prefers a swing trade, then you should know that your swing trade is just about around the corner. So be patient and eventually wait for those that opportunity to go for those short trading opportunities. So with a very strong dollar, when I mentioned that the king is back, you can see how the pound USD has erased its early morning gains, and now it's headed back downwards. So it's now safe to assume that the market is headed back downwards. And the candlestick on the forward chart is currently very telling, indicating a rejection of higher prices and a strong entry by sellers. So some further downside momentum is expected. It's the same case for Euro USD, which was pretty strong, especially after the inflation data showed that the estimate for inflation in the Eurozone had dropped to 2.9%. And with 2.9% being lower than expected, then there was this expectation that the euro will start weakening, mainly because the ECB may not go for further rate hikes. 2.9% is pretty close to the 2% target. So in this case, from what we are seeing here is the dollar coming back strongly in the markets. And then from the forward chart, what we are seeing here is a very strong entry by sellers, which is indicative of a potential bearish momentum. So for USD CAD, then we are seeing a strong momentum upwards. Dollar basically regaining against the Canadian dollar. And for Audi USD, we saw the market rally yesterday, didn't quite get to the target, moved back downwards, attempted to go up during the London session, but now we are seeing some further downside momentum, basically indicating that this market is unable to break higher. So in this case, there's a high likelihood that the Audi USD keeps going back downwards and perhaps retests this previous bottom of 0.62895. So US equity indices were pretty bullish early in the morning, but now they're changing direction. So as the dollar strengthens, we are seeing them now begin to weaken. Even the Dow Jones is taking a step backwards. So in this case, I expect some further downside momentum. And of course, for the S&P 500, the same. Market changing direction and is now headed further back downwards. So as for Brent oil, it has really struggled to make bounce from this area here. So notice how we had this very strong pin back, indicating a rejection of lower prices and entry by buyers, but somehow this momentum has not been able to materialize. So in this case, or in these scenarios, I prefer remaining patient and then observing the consolidations as they happen. So in this case, if you are trading Brent oil or US oil, all you have to do is to monitor this area here and then potentially look for a break. And it's the same thing on the lower side. So we should be monitoring these areas to see if the market either breaks towards the upper side or to the lower side so that we can get more confirmation. So this is basically how it looks like in the 15-minute chart. So at some point, we will be expecting to see a break, but then there's a high likelihood that the break would be on the upper side, especially after the strong pin bar that we saw yesterday in the evening. So European equity indices are pretty strong and bullish in the morning, but now they are losing momentum. So if I had a buy trade, I would be exiting. And Euro 50 are also doing the same. So the first one was the French 40. And of course, if you look at the UK 100, it's already erasing the gains. So all of them have hit some form of resistance and started changing direction. So France 40, the same, the Euro 50, the same. And we could be expecting some form of pullback after we have hit that resistance. So as for the USD CNH, we have broken out of this resistance. So a level that the market was clearly unable to break for a while. And now USD CNH is headed higher. So we could be looking at the previous highs as potential targets if you are participating in this particular market. So that's it for the day. Thank you very much, guys. Thank you for your time. So one last question here is to check on Euro JPY. So I think we have done a pretty good analysis on on USD JPY. So we should be expecting something similar. But then if the market were to reverse, then I believe the Euro JPY pair would be falling stronger than the others. So with a much weaker euro, you can see the reversal is already beginning to happen, with the yen now strengthening against the euro. So after this bullish momentum that was pretty strong in earlier trading, we are seeing the market pull back quite strongly. So from the 1 hour chart, this is how it looks like. Though it's staggering, I believe the easiest target is the previous high. So this pullback basically implies that the market is looking to retest this area here. So 159.9 seems like a nice target for anyone who is already in a short selling position. So as for pound yen, you can see it's a major resistance level. The market has tested this twice, unable to break, and now on the third time it was unable to break, and we are seeing the reversal happening. So this could prove to be a nice entry for a short selling position, targeting even lower prices, with of course the stop loss going just above that area, and target prices being towards the open of the day. So potentially a nice entry exit with a very good reward versus the risk involved. So that's it for the day. Thank you, guys. So if the Fed keeps rates constant, as has happened to the rest of other pairs, major pairs, what's your view? I think there's a very strong likelihood that the Fed will basically hold rates level, the current rate. So from the CME FedWatch tool that basically uses the Fed funds futures, it's basically indicating that there's a 99.6% possibility that the Fed will hold interest rates at the current level, and a very small possibility that it will hike on the next meeting. That should be quite a distance from now. So in this case, we should be expecting that rates are hold at the current level. But then a quick look at US 10-year bonds. You'll notice that the yields are currently at 4.9%, very close to 5%. And this is quite an interesting period because there's a lot of global uncertainties, especially in the Middle East. Other markets are not doing particularly well. So this is deemed as a pretty good return, especially if you're just buying the dollar and then using the dollars to buy the bonds. So in this case, with the bond yields rising and the US holding rates at that level, and if they keep promising what they have been promising, which is basically keeping rates higher for longer, then the investors in these bonds are bound to benefit the most. So in that case, we should be expecting the dollar to continue strengthening as more and more demand is experienced with these bonds. So shorter term bonds are even earning more. So there's a lot of investors going for the shorter term bonds, and that explains why there's a yield curve inversion. So in this case, we should be expecting to continue seeing very strong demand for the dollar. And as a result of that, we should also be seeing the dollar strengthening against other currencies. So thank you guys for your questions. Thank you for your participation. I hope I shared some good insights on the Bank of Japan situation and the Japanese yen. And now you know where to apply your positions.